Guys, it's great to have you here. Strong start to the week here for all the major averages. Continues to be risk on. Eric, you're overweight equities. You're also overweight real assets like commodities. Why is that the place to be right now in this market?
Morgan, we still think there's, despite a slowing tone of the broader economy, a decent environment for both consumer spending and business capex to continue. So we think that being involved in both business-to-business software as well as tech is where you want to be. We also think that while there's a little bit of a lofty expectation for earnings growth next year, at least in the U.S., it's still a decent environment. Again, we have a lot of noise coming in the back half of the year, whether it's the Fed or the election, but we still think those two trends, consumer spending and business capex, continue. That's why we're still bullish.
Okay, we want to bring Mike Santoli into the conversation as well. Mike, yep. Just as we didn't close on the highs here for the S&P, but we did jump 1% in trading. We finished up about, looks like, 0.75%, 54.73, a new record high. We've had a string of them lately. Not too terribly much, though, in terms of potential catalysts here, other than perhaps retail sales and jobless claims later this week. I guess what are the next things to watch?
Yeah, no, it's actually interesting in the sense that there wasn't necessarily much of an identifiable catalyst today either, except that it was just the pile-on momentum in a lot of those NASDAQ stocks that dragged the rest of the market along. I would say retail sales matter a fair bit, but I would also turn to David Kelly here and ask, essentially where you feel we are after the Fed meeting last week, after we got some of the more signs of disinflation, as to whether we are in fact tracking for the scenario that the markets have been essentially trying to price in for over a year, which is benign, softish landing.
Yeah, that's where I think we still are. And I think what's really going on here is a lack of news to get scared about is allowing people just to keep on doubling up on their bets. And it's, I was watching the evening news a few nights ago, and they led with shark attacks. And whenever the evening news leads with shark attacks, there really is not that much for investors to worry about. And that's kind of where we are. So we've got this smooth economy, slowly coming down 2%, inflation slowly heading down below 3%. It's very comfortable. Margins look good. And so what's happening is investors, whatever liquidity they have, keep on adding to whatever bets they're making. So you end up with, this is a great environment in which to grow bubbles. And that's what I kind of worry about here. That the momentum, the narrowness of this market, it's still there, and there's a huge dispersion in valuations both within the U.S. market and then between the U.S. and around the world. So I think there's danger within the market just because of this concentration, but I don't see it ending anytime soon until you have some shock to disturb this very bland soft landing scenario.